So a key economic indicator released today shows the U.S. economy grew in the third quarter.
Slow clap, okay? Because it's the first increase the nation has seen this year. The new data shows the gross domestic product increased at an annual rate of 2.9% in the third quarter. Now, this rebound comes after 6 months of decline and looming fears of a recession.
But consumer confidence fell in November, and layoffs and ongoing high inflation continue to pose problems. The latest data there reflects a gloomy outlook as we head into the holiday season. And private hiring increased by just 127,000 jobs this month. That's a steep drop from October, well below the 190,000 estimate.
For more on all of this, let's bring in Ryan Payne. He's the president of Payne Capital Management. So, Ryan, considering there's a lot of data points to unpack that Lana and I just walked through, what's the overall takeaway that this says about the state of the economy? I'm assuming that things aren't back to normal, so to speak, but they're not as bad as they were. You tell us.
Yeah, I think the latter is it, right? Things are not as bad as Wall Street strategists and economists have been telling you all year. Over almost 3% GDP growth, that's pretty good. And if you start looking at fourth quarter GDP growth, which we're starting to see forecasts on that, could be like over 4%. So that means growth is actually speeding up, not slowing down. That doesn't sound very recessionary to me, which I think that's a phenomenal number. And I think that's a very positive when we start looking forward-looking what the economy is going to do next year.
So it sounds like you think that Errol's slow clap was warranted.
It was very slow. Couldn't hear it. It was so slow you couldn't hear it, but it's valid.
But I'm curious, of course, what the Fed's going to do. It's hinted that it might slow its interest rate hikes now that the job market seems to be slowing a bit. But we haven't gotten, I think, a really clear message about how important Friday's jobs reporting is to their thinking. What more can you tell us?
Well, I think it's going to be really hard to slow down the job market. And that sounds kind of counterintuitive. We want to stop people from having jobs. That doesn't make a lot of sense to me. And I think we have to think about it demographically speaking. We have an aging population. So demand for labor has been extremely high. I think it's going to continue to stay high. But we don't have enough Americans to fill those jobs, which means labor market's probably going to stay tight no matter what the Fed does. That means wages are going to stay strong, which is good for the consumer. But I do think the Fed is going to have to pivot because we saw the inflation data last month. It slowed. And right before the meeting next month, we're going to get another inflation number. And if that comes down again, well, the Fed's going to kind of be forced to look at the data and say, okay, wait, maybe we need to raise interest rates a little bit slower here. And if they do that, I think that's going to be huge because markets now are starting to price in slower rate hikes. And maybe at some point, the terminal rate's like 5% next year, not to get too wonky. Well, we've already adjusted to that reality. And I think that's the case. That's a really good sign, especially if inflation's coming down, which it looks like on the ground floor, it clearly is.
And we have to acknowledge what's happening in the background of these low numbers as far as employment is that people are striking like the railroad workers for better terms, more time off, more comfortable jobs as well. That's happening also. Ryan Payne, great to chat with you, though. Thank you very much.
Thanks for having me.